Welcome back, everybody, for another deep dive. This time, we are stepping into the sometimes intimidating, always fascinating world of automated trading systems.
Ah, yes. These systems use algorithms and predictive models to, well, make buy and sell decisions in the market.
Automatically. I mean, if you've ever thought about how we could use data to sort of try and get ahead of those market movements, well, this is a deep dive for you.
It really is.
And you know what else?
What's that?
The source material for this deep dive goes really deep into this software called TSSB.
Oh, yeah, TSSB, Trading System Synthesis and Boosting.
That's the one. It's a platform specifically designed to build these automated trading systems.
And the interesting thing about TSSB is that it tries to cater to kind of two distinct audiences. You have the newcomers who, they're just starting to explore the world of automated trading.
So they need a little more hand-holding.
Exactly. But then you also have experienced traders who want more fine-grained control over their systems.
They want to get under the hood and tinker.
Yeah.
So before we get too far, can we just kind of take a step back for a second?
Sure.
I think we need to, lay some groundwork here.
Absolutely.
What exactly are predictive models? I mean, I think of like a crystal ball, but I'm guessing it's a bit more complex.
Right. It's not magic, unfortunately.
Okay.
Think of predictive models as a way to use historical data, like past price trends, to try and forecast future market movements. Like, imagine you're a detective. You're looking for clues in the past to try and predict what might happen in the future.
So instead of relying on gut feeling, we're using data to try and get an edge in the markets. That makes sense. But how can we be sure that these models are actually predicting something real and not just getting lucky?
That is the key question, isn't it?
It is.
And that's where the statistical validation tools in TSSB come into play.
Okay.
They help us to understand if a trading system is truly making good predictions or if it's just, as you said, getting lucky.
Because luck runs out eventually.
It always does.
And you don't want to base your financial decisions, your trading decisions, on luck.
You really don't.
So speaking of making sure our system isn't just, pulling a rabbit out of a hat, our sources mention a couple of ways to test these systems. Walk-forward testing and cross-validation. Can you kind of walk us through what each one does?
Of course. And they're great names, aren't they? Very descriptive. So walk-forward testing. Imagine you are driving a car, right? And you're constantly adjusting your steering to navigate the road. That's kind of similar to walk-forward testing. You train your model on a portion of data, test it on the next chunk, and then you just keep repeating that process. Retraining, testing, to see how the model adapts to new information in the market.
It's like giving the model a driving test with all these different kinds of road conditions.
Exactly.
All right, so that's walk forward. Now, what about cross-validation? What's that one all about?
Cross-validation is a little bit different. Imagine instead of driving and reacting, you study a map of the entire route before you even hit the road. So with cross-validation, you take your data and you divide it up into different sections, or folds as they're called.
Fold, okay.
And then you train and test the model on different combinations of those folds. So you're trying to maximize the use of the data that you have.
Okay, I think I'm starting to see the difference. Walk forward is like driving the market in real time and adapting. And cross-validation is more like planning a route beforehand.
Yes, a good way to put it.
But with all of this testing, isn't there still a risk of some kind of bias creeping into our results? Like, how do we know we're being total objective?
It's a great point, and bias is definitely something to watch out for.
Yeah.
One sneaky type of bias is called overlap bias, and it can happen when the data we use to make a prediction overlaps with the data we use to train our model. It's kind of like cheating on a test by peeking at the answers.
Oh, yeah, I remember those kids in school. Never ended well for them.
No. Luckily, TSSB has features to try and address this overlap bias, so we can hopefully make sure that our tests are fair and accurate.
All right, so we've taken care of the cheaters.
Hopefully.
But what about the big picture? We have to make sure our system doesn't just work well on the data it was trained on, but also on new data it's never seen before.
Right, that's called generalizability.
Okay. So how do we make sure our model can handle the unexpected?
Well, For that, we need to choose the right performance statistics.
Mm-hmm.
We need things that can generalize well to out-of-sample data. So we have confidence that our system isn't just a one-hit wonder. For example, something called the profit factor,
Okay.
which basically measures how much profit you make for every dollar you lose. That's something that generally has good generalizability.
It's not just about winning, it's about not losing too much either.
Exactly.
So let's say we already have a trading system. It's doing okay, but we want to try to kick it up a notch.
Improve its performance.
Exactly. Our sources mention this concept of filtering trades, so not taking every trade. Can you kind of unpack that for us?
Sure. Imagine you have a scout who brings you potential basketball players. Now, they all have talent, but not every player is going to be a superstar, right?
Right.
Well, you could use a predictive model as a filter to help you focus on the players who have that superstar potential.
The cream of the crop.
Exactly.
So it's all about being more selective.
Yes.
But how does TSSB actually define those indicators and targets it uses to make those decisions? I mean, where does it get its information from?
TSSB uses something called a variable definition list.
Okay.
It's a simple text file where all the details about your indicators and targets are laid out. It's like a recipe book for your trading system. You choose the ingredients and you choose the instructions.
And I'm hungry for some actual examples of those ingredients. Can you give us a taste of some of the interesting indicators that caught your eye in our source material?
Of course. One that stands out is called linear per ATR.
Okay.
And it measures how fast prices are moving relative to their recent volatility. It's kind of like measuring the momentum of a stock.
So if a stock is usually pretty quiet and then it suddenly starts jumping up, it would have a high linear per ATR.
Exactly. Like it's breaking out from its usual patterns. And then there's reactivity, which is this interesting indicator that tries to figure out if the market is trending up or down. Like, is it feeling bullish or bearish?
It's like taking the temperature of the market.
Exactly.
These indicators sound really cool, but our sources hint that TSSB can go even deeper.
It can.
Can you give us a little sneak peek into some of those advanced features?
So we have things like pooled variables,
Okay.
which essentially extract information from multiple markets to try and find broader patterns.
Getting the big picture.
Yes. And then there's wavelet analysis,
Okay.
which examines the data at different timescales, kind of like zooming in and out with a microscope.
Wow. Those sound pretty powerful. One concept that really piqued my curiosity was purifying the VIX.
Ah, yes.
It sounds almost mystical. What is that all about?
Well, the VIX, the volatility index, is essentially a measure of fear in the market. Imagine isolating those pure, unpredictable shocks in that fear. That's what purifying the VIX aims to do.
Like sifting through all the noise to find those nuggets of fear that could give us an edge.
Yeah, but remember, even these purified indicators are just one piece of the puzzle.
Of course.
Successful trading requires a balanced approach, combining different forms of analysis, risk management, and a good dose of caution.
And humility.
Absolutely, because the market will always find a way to surprise us.
Always. This world of predictive models and TSSB is a deep dive indeed, and we've only just begun.
Now, TSSB doesn't stop at just individual trading systems. It lets you build entire portfolios of these systems.
So instead of putting all our eggs in one basket, we're creating like a team of systems.
Exactly, each with its own strengths and weaknesses, hopefully working together to get better overall performance.
That makes a lot of sense, spreading the risk. But how do we manage all these different systems? Like, how do we optimize the portfolio?
TSSB uses something called walk-forward optimization,
Okay.
where it periodically adjusts how much capital is allocated to each system based on how it's been performing recently.
So it's like a coach constantly tweaking the lineup based on who's hot and who's not.
Yes, good analogy.
You know, speaking of performance,
Yeah.
I've had my own share of humbling experiences trying to build these trading systems. I remember I once created a system based only on moving averages.
Okay.
Back-tested beautifully. I thought I had cracked the code,
I've been there.
but when I actually started using it, disaster.
Yeah, the market has a way of humbling us.
It really does. That's when I learned about overfitting.
Ah, yes. The classic overfitting trap.
What exactly is that?
Overfitting is when a system performs really well on historical data, but then it fails to generalize to new data. It's like training a basketball player only on free throws. They'll be amazing at free throws, but they might struggle in an actual game.
So how do we avoid falling into that trap? How do we make sure our systems can handle the real world?
Well, TSSB offers some tools for that.
Okay, good.
We've got the cross-validation and walk-forward testing we talked about before.
Right.
And then there are things like regularization, which helps to prevent the model from becoming too complex.
So it's like simplifying things so it doesn't get lost in the weeds.
Exactly. You want to strike a balance between complexity and simplicity.
Makes sense.
Yeah.
Now, our sources mention a couple of features that sound pretty advanced. Expression transforms and vector operations. What are those all about?
So expression transforms allow you to create new indicators by manipulating existing ones. Like you can add, subtract, multiply, divide. It's a bit like having a set of building blocks. You can combine them in different ways to create something new.
So we can build custom indicators.
Precisely.
Oh, yeah.
And then vector operations let you do calculations on entire arrays of data.
Okay, that sounds pretty powerful, but also a bit intimidating.
You don't need to be a math whiz to use TSSB.
That's good to hear.
It has a lot of pre-built indicators and user-friendly tools that make it accessible even for those who aren't hardcore programmers.
That's a relief. Now, we talked about linear per ATR earlier, but our sources mention another indicator with the same name, but a slightly different focus.
Yes, it's a bit confusing, I know. This other linear per ATR focuses on measuring the trend of prices relative to their recent volatility. So you're not just looking at how fast prices are moving, but also taking into account how much they've been fluctuating.
It's like understanding not just the speed, but also the bumpiness of the ride.
Exactly.
And there's also quadratic per ATR. Right?
That's right. And that one helps us to understand the acceleration of prices.
Acceleration.
Yes, like is the trend itself speeding up or slowing down?
Yeah.
Think of a car. You don't just want to know its speed, you also want to know if it's accelerating or braking.
So we can anticipate those turns in the market.
Precisely. And then there's reactivity, which tries to figure out if the market is moving decisively in one direction or just sort of bouncing around.
Like, is it confident or hesitant?
Yes, a good way to think about it.
Now, those advanced concepts we touched on earlier, pooled variables and wavelet analysis, can you give us a little more insight into how those work?
Sure. Pooled variables are essentially gathering information from multiple markets to try and gauge overall sentiment.
So it's like getting a broader perspective on the market.
Exactly. And then wavelet analysis is looking at the data at different timescales or resolutions.
So we can see both the short-term and the long-term trends.
Yes, it's like having a special lens that lets you zoom in and out on the market.
Now, with all these indicators, what exactly is TSSB trying to predict? What are the targets? Our sources mention fixed hold and ATR exit.
So these are different ways of defining what outcome we're looking for. Fixed hold is very simple. It looks at the market's movement over a fixed number of bars, ignoring any fluctuations in between.
Okay.
It's like saying, I'm going to hold this stock for 10 days no matter what happens.
Well, what if something happens? What if there's a big move in the market?
That's where ATR exit comes in. That's a more dynamic approach that uses the average true range, or ATR,
and that's
a measure of volatility. So you're essentially setting your exit points based on how bumpy the market is.
It's like adjusting your driving speed depending on the road conditions.
Exactly.
Now, we can't forget that the market is constantly changing. Our sources mention non-stationarity and structural breaks. What are those all about?
Right, those are big challenges.
Yeah.
Non-stationarity means that the dynamics of the market can shift over time. What worked in the past might not work in the future.
So it's like the rules of the game are constantly changing.
Yes, and structural breaks are even more dramatic. They're sudden shifts in market behavior, often caused by unpredictable events.
Like a black swan event.
Exactly.
So how do we deal with that? How do we make sure our systems can adapt?
Well, we have to constantly monitor our systems and be willing to make adjustments.
It's an ongoing process.
It is. We can't just set it and forget it.
Now, speaking of making adjustments, our sources mention purifying indicators. What is that all about?
It's kind of like refining crude oil to get gasoline.
Right.
You're trying to remove the predictable parts of an indicator and isolate the unpredictable shocks that might be useful for a prediction.
So we're looking for those pure nuggets of information.
Exactly.
But isn't that a bit risky? I mean, we're basing our decisions on unpredictable things.
It is risky, and that's why it's important to use it carefully, as part of a broader approach. Remember, there's no silver bullet in trading.
There are no guarantees.
No.
But with all these indicators and techniques, how do we even know where to start? How do we choose the right ones for our system?
That's where experience and judgment come in. But TSSB does offer some help.
Okay, that's good.
It has statistical tests, visualization tools, and even automated model selection algorithms. to help guide our choices.
So it's not just a number crunching machine. It actually helps us make sense of all the data.
Exactly.
We've covered a lot of ground here. It's amazing how many different indicators and techniques there are.
It's a testament to how complex and ever-evolving the market is.
It really is. But before we get too carried away with all these indicators, let's shift our focus to the heart of our deep dive.
The predictive models themselves.
Let's do it. So we've explored all these indicators and targets and all of this data, but now we need to figure out how to actually turn it into a system that can make decisions in the market. How do we do that?
Right. We need to make sure our predictions aren't just, random. We need to see if there are statistically significant relationships between our indicators and, well, what happens in the market.
How do we test that?
Well, one way is to use something called the chi-square test. It's a statistical test that can help us determine if there's a real connection there or if it's all just coincidence.
The chi-square test. That rings a bell from my statistics class, but can you refresh my memory on how that works in the context of trading?
Sure. Let's say you have an indicator like the linear per ATR we talked about earlier,
Right.
and you want to see if it actually has any predictive power for future market returns. Well, the chi-square test helps us to figure that out. Does the indicator actually have a relationship with the thing we're trying to predict?
Got it. So it's like we're putting our indicator on trial,
Exactly.
seeing if it has enough evidence to prove that it's actually a useful tool.
Right.
That's fascinating. And I remember from the source material that TSSB actually has a visual tool for doing these chi-square tests.
It does.
So we can actually see the results in a way that's easy to understand.
Exactly. You can select the variables, set the parameters. You can even run more advanced tests, like the Monte Carlo permutation test.
Oh, wow.
Yeah, it's a powerful tool.
So it's like a virtual laboratory for testing our indicators. I love it. But the chi-square test isn't the only way to measure predictive power, right?
Right. There are other measures like Kramer's V and lambda.
Okay.
Okay.
Can you unpack those a little for us?
Sure. They're basically ways of measuring how strong the relationship is between the things we're using to predict, the predictors, and the things we're trying to predict, the targets.
Right. Like, how much of a connection is there, really?
Exactly. Kramer's V is good for when we have categorical variables, which are common in trading systems. Like if we're dividing our indicators into high, medium, and low categories.
Ah, so it tells us if those categories actually mean something.
Yes. And then there's lambda, which looks at how well the predictor can predict the target, but without considering the reverse relationship.
So we only care about predicting the market, not what's predicting our indicator. Makes sense. But with all these different ways to choose indicators, how do we avoid picking too many and overfitting our model?
That's always a risk. One technique that TSSB offers is called non-redundant predictor screening. It's a way to select indicators that are both predictive and unique.
Ah, so each indicator brings something different to the table.
Exactly. You don't want a team full of players who all do the same thing.
I like that analogy. So we spent a lot of time talking about indicators, but now I want to talk about the heart of the system, the predictive models themselves.
Right. The brains of the operation.
Our sources mentioned a whole bunch of different models, from linear regression to neural networks to decision trees. Where do we even begin?
It can be overwhelming, for sure. But linear regression is a good place to start. It's relatively simple, and you can really see how each indicator contributes to the final prediction.
Linear regression, that takes me back to Stats 101. Can you remind us how that works?
Imagine you're trying to draw a straight line that best fits a bunch of data points. That's basically what linear regression does.
Finding the average trend in the data.
Right. And in trading, we're using that line to try and predict future market movements based on our indicators.
Makes sense. But sometimes things aren't that simple, right? Sometimes those relationships are more complex.
Exactly. That's where neural networks and decision trees can be helpful.
Neural networks. Those always sound so futuristic. But how do they actually work?
Think of it like a big web of interconnected nodes.
Oh,
Each node processes information and passes it on to the next layer. And during training, the network learns by adjusting the strength of those connections.
it's like the network is building its own understanding of the market.
It is.
Wow, that's incredible. And TSSB has different types of neural networks,
It does, yes.
so we can choose the one that's best for our needs.
Exactly.
And what about decision trees? Those sound a little less intimidating.
Decision trees are basically a set of rules that help us split the data into smaller and smaller groups based on the values of our indicators.
Like a flowchart.
Yes, exactly.
And TSSB can even use something called boosted trees, right? where we combine multiple trees,
Yes, it's like having a committee of experts.
each with their own perspective.
Precisely.
So we've got all these different models making predictions, but how do we actually use those predictions to make trades? I mean, do we just blindly follow them?
Not quite. There are different approaches we can use. One is threshold-based rules, where we set a threshold for the model's prediction. And if the prediction crosses that threshold, we might buy or sell.
So it's like a trigger point.
Exactly. And TSSB helps us optimize those thresholds.
Okay, so it's not just about following the model blindly.
No, we have to use our judgment.
There's another approach our sources mentioned, relative ranking. When would we use that?
Relative ranking is useful when we're trading multiple markets.
Okay.
Instead of looking at absolute predictions, we rank the predictions across all the markets, and then we focus on the ones that look the most promising.
So it's about finding the best opportunities.
Exactly.
And then there's triggering and pre-screening. What are those all about?
Triggering allows us to basically turn our trading system on or off based on certain conditions.
Oh, interesting. So we can control when it trades.
Right. And pre-screening helps us filter the data that we use to train and test our models to make sure we're using the most relevant data.
It's all about refining our approach.
It is.
Well, this has been an incredible journey. We've learned so much about TSSB and predictive models and automated trading systems. It's clear that TSSB is an incredibly powerful tool, but it's not a magic bullet. It takes knowledge, skill, and a deep understanding of the market to use it effectively.
It's a tool, not a solution.
Exactly.
Yeah.
Well said. And as we wrap up this deep dive, I want to leave our listeners with one final thought. We know the market is constantly changing. So what methods would you explore to make sure that your predictive models are always adapting and staying ahead of the game?
That's a great question, and honestly, it's the most important one. We have to constantly monitor our systems, be open to new ideas, and never stop learning. The market is always evolving, and we need to evolve with it.
Could have said it better myself. This has been an incredible deep dive, and we want to thank you all for joining us. We hope you've learned something new and are excited to explore the world of predictive models and automated trading systems.